Most traders are looking at the wrong thing. They watch the news. They follow analysts. They read reports written by people who haven't touched a live position in years. And then they wonder why the market keeps moving against them the moment they enter. The answer has been sitting in front of them the whole time. On the chart, in the candles, in the silent language that price speaks before it moves. I want you to understand something fundamental before we go any further. A candle is not just a price bar. It is a record of human behavior. Every single candle represents a battle. Buyers pushing up, sellers pushing back. And when that battle is over, the candle closes and tells you exactly who won, by how much and how convincingly. That's not a small thing. That's everything. Think about what happens when a candle opens and immediately moves in one direction, strong and clean, closing near the high with almost no wick. What are you seeing? You're seeing conviction. You're seeing a crowd of buyers who entered and were never challenged. The sellers stepped aside. That kind of candle doesn't appear randomly. It appears when something has shifted in the balance of power, and the market is quietly telling you which side has taken control. Now ask yourself, how many times have you ignored that signal because the fundamentals didn't agree? How many times have you said, but the news is bearish, while the chart was forming a series of strong bullish closes? The market doesn't care about your opinion. It never has. Here's where most traders go wrong. They look at a single candle in isolation. One candle means nothing. Or rather, one candle means very little until you understand the context it lives in. A small indecision candle near the bottom of a long downtrend, after a sequence of selling, after volume dries up. That same candle means something entirely different than the same pattern in the middle of a range going nowhere. Context is the interpreter. The candle is the sentence, but context is the language. When you start reading candles in context, you begin to notice something uncomfortable. The market often telegraphs its next move well before it happens. Not always clearly. Not in a way that removes risk. But there's a rhythm, a cause, an effect chain that repeats itself because human nature repeats itself. Fear looks the same in 1920 as it does today. Greed leaves the same fingerprints. Consider the long upper wick. Price runs up, traders get excited, they buy. And then the sellers absorb every bit of that enthusiasm and drive price back down before the candle closes. What just happened? Rejection. The market tried to go higher and was refused. That's not noise. That's a message. And if you see that wick appearing at a level where price has been rejected before, you're not looking at coincidence. You're looking at supply, real, deliberate, patient selling. And the candle just showed you exactly where it lies. This is why I want you to stop thinking about candles as pictures and start thinking about them as evidence. Every candle leaves evidence of intent. The body tells you where the commitment was. The wick tells you where the fight happened. The size tells you how much energy was involved, and the sequence. The story those candles tell one after another. That is where the real intelligence is. What does a sequence of shrinking candles tell you? Energy is leaving the move. The momentum that was driving price is fading. Whatever force was in control, buyers or sellers, they're losing their grip. And when a market loses momentum near a key level, it rarely just stops. It reverses, not always, not with certainty, but with enough frequency that a disciplined trader can build their entire approach around recognizing that moment. Do you understand what that means practically? It means you're not guessing, you're reading, you're interpreting behavior. You're watching how the crowd acts and responding to what they reveal, not to what you hope or fear they might do. There's a psychological dimension to this that most people never fully appreciate. When you learn to read candles honestly, you stop projecting. And that is one of the most dangerous habits a trader can carry. Projecting your own buyers onto the chart, seeing what you want to see rather than what is actually there. The chart is indifferent to your position. It doesn't know you're long. It doesn't care that you need this trade to work. But the candles will tell you, if you let them, whether the trade was right or whether you entered on hope. The trader who reads price honestly, without prejudice, without needing the market to confirm his opinion, the trader has an enormous edge. because most of his competition is doing the opposite. Most traders look at where price went. The smarter question is where price tried to go and couldn't stay. That distinction is everything. And the wick is where that story lives. When a candle forms a long upper wick, something specific happened. Price moved up, sometimes aggressively, and then got pushed back down before the candle closed. That's not random. That movement represents real orders, real decisions, real money entering the market at that level and saying no. The sellers at that price were strong enough, numerous enough, or patient enough to absorb every buyer who showed up and still drive price back down. The wick is the physical record of that refusal. Now think about what that means for you as a trader. You're not looking at a line on a chart. You're looking at evidence of where supply lives, where the market was tested and rejected. And if you've been in this long enough, you already know that markets have memory. Price returns to levels where decisions were made. When it returns to a level marked by a long upper wick, it is walking back into a zone where sellers have already demonstrated they are willing to act. Do you see why that matters? It's not about the shape of the candle. It's about what the shape represents in terms of human behavior. The lower wick works the same way, but in reverse. Price drops. Buyers step in with enough force to push it back up before the close, and the wick below the body marks the level where demand showed itself. A long lower wick at a key support level is not a minor detail. It's a signal that someone, or many people, found that price acceptable enough to buy aggressively. The rejection was real and it was fast. Here's where most traders make a critical mistake. They see the wick and they draw a conclusion too quickly. One wick, even a significant one, is not a trade. It's information. It raises a question. Is this level genuinely defended, or was that a temporary reaction? The answer comes from what happens next. If price returns to that level and the wick forms again, now you have confirmation. The same zone rejected price twice. That level is not a coincidence anymore. It's a boundary. What makes a wick meaningful versus one that can be ignored? A few things. First, location. A long wick in the middle of open space on a chart carries far less weight than a long wick forming precisely at a previous high, a round number, or a level where price has already reacted before. Location gives the wick significance. Without it, the wick is just volatility. With it, the wick becomes a statement. Second, proportion. A wick that is twice the size of the candle's body is telling you something loud. A wick that is barely longer than the body is a whisper at best. The more extreme the wick relative to the body, the more forceful the rejection was. The market didn't just nudge price back. It refused it completely and quickly. Third, what surrounds it. A long upper wick appearing after a series of strong bullish candles right at a resistance level. That's a warning. The trend came up, tested the ceiling, and was turned away. The preceding strength makes the rejection more meaningful because it means even with momentum behind it, the buyers still couldn't hold that ground. That's a significant failure. This is the lie detector quality of the wick. Price told one story during the candle. It moved, it reached, it suggested continuation. And then the close told the truth. The close is where the market settles its accounts. Everything before the close is noise, negotiation, testing. The close is the verdict. And when the close contradicts the movement within the candle, you are watching the market correct a false narrative in real time. And the first sign of that weakness is rarely dramatic. It doesn't announce itself with a crash or a sudden reversal. It appears quietly in a single candle, closing in the wrong direction, against the trend that everything else around it is still supporting. Most traders dismiss it. They call it noise. They call it a pullback. And sometimes they're right. But sometimes that one candle is the first crack in a wall that's about to come down. This is why you have to take it seriously before you decide to dismiss it. When a market has been moving in one direction with consistency, higher highs, candles closing strong, momentum seemingly intact, and then a candle appears that closes in the opposite direction, something has shifted. Not necessarily permanently, not necessarily with enough force to reverse the entire move. But the balance changed even briefly, and that change left a mark on the chart that you should not walk past without asking why. Think about what had to happen for that candle to close the way it did. The prevailing force, let's say buyers in an uptrend, had to lose control of price for an entire candle period. Sellers came in with enough conviction to take price down and hold it down through the close. That's not nothing. In a healthy trend, that doesn't happen. In a healthy uptrend, dips get bought quickly, aggressively, and the candle closes back near the high. When a candle closes instead near its low, against the trend, it means the buyers who normally step in and defend the move, they hesitated, or they weren't there. Do you understand the implication of that? It means the automatic buying that was sustaining the trend has weakened. The floor held for now, but it held less confidently. The reason this candle is the first whisper of exhaustion is because of what exhaustion actually is in market terms. It's not a sudden reversal. It's a gradual withdrawal of the dominant force. Buyers who are aggressive become passive. Sellers who are passive become willing. That transition doesn't happen in one moment. It happens across a sequence of candles, and the counter, trend close, is often the first visible evidence that the transition has begun. Now here's what separates a meaningful counter, trend candle, from one that is genuinely just noise. Size matters. A small-bodied candle closing slightly against the trend is a hesitation, not a warning. But a candle with a real body, one that closes meaningfully in the opposite direction, covering significant ground, that carries weight. The market didn't just pause, it pushed back with intention. Location matters even more. A counter-trend candle appearing in open space, away from any significant level, is far less meaningful than one appearing right at a previous high, at a resistance zone, or after a long uninterrupted run. When price has traveled a great distance without rest, and then produces a strong counter, trend close, it is showing you that the energy behind the move is running out precisely where it needed to perform most. There's a psychological layer here that's worth sitting with. Trends are sustained by belief. Traders stay in the direction of the trend because they trust it, because it has rewarded that trust repeatedly. The moment a strong counter, trend candle appears, it introduces doubt, and doubt in markets is contagious. The trader who was confidently holding a long position now has a reason to question. The trader who was waiting to buy the dip now waits a little longer. That hesitation, multiplied across hundreds or thousands of participants, creates the very slowdown that confirms the exhaustion. The candle caused the psychology, and the psychology extends the candle's effect. That's how markets turn, not in one explosive moment, but in a sequence of cause and effect that begins with something as quiet as a single close in the wrong direction. The market has a volume. Most of the time it speaks at a normal level, steady, measured, readable. But occasionally it raises its voice, and when it does, the worst thing you can do is treat it like background noise. A candle that is 2, 3, or 4 times the size of the candles surrounding it is not a normal candle. It is an event. Something changed in the balance of participation. More money entered. More urgency was present. More conviction was behind the move than anything you've seen in the surrounding price action. And events carry meaning. They don't appear without cause, and they don't disappear without consequence. Think about what produces an unusually large candle. It's not retail traders making slightly bigger bets. It's a sudden, overwhelming imbalance between buyers and sellers. Either demand became so aggressive that sellers were consumed and price ran, or supply hit the market so hard that buyers were overwhelmed and price collapsed. Either way, what you're watching is a moment where the normal equilibrium broke down completely, and those moments leave marks that the market respects long after the candle has closed. So the first question you should ask when you see a candle of abnormal size is not where it went, but why the energy was suddenly that strong. Because the answer to that question determines whether the move continues or exhausts itself. Here's a cause and effect chain worth understanding. When a large bullish candle appears, strong close, significant range, body dominating the chart, it does 2 things simultaneously. It moves price and it traps people. The traders who were short through that candle are now in pain. The traders who were waiting to buy at a lower price have now been left behind. Both groups face pressure to act. The shorts to cover, the sidelined buyers to chase. That follow-through pressure is what often pushes price further in the same direction immediately after. The large candle didn't just move price. It created the conditions for the next move. Do you see how one candle can set the entire emotional tone for what follows? But this is also where the danger lies, because a large candle can just as easily mark exhaustion as continuation. When a candle is dramatically larger than everything around it and appears after a long trend has already been in place, the interpretation shifts. That size is no longer the beginning of energy. It may be the final release of it. All the remaining buyers who hadn't yet committed piled in at once, creating one enormous candle, and now there's no one left to buy. The move burned through its fuel in a single dramatic display. This is why size must always be read in context, but never ignored. The candle's location within the trend changes its meaning entirely. Early in a move, a large candle is acceleration. Late in a move, the same candle may be a climax. And climax moves are frequently followed by sharp reversals because they represent the market running out of the very participants who are sustaining it. What should you be doing when you see a candle of unusual size? First, stop. Don't react immediately. A large candle creates urgency, and urgency is the enemy of good decision-making. Let the candle close. Let the next candle begin to form. What happens in the immediate aftermath of an abnormal candle tells you more than the candle itself. If the next candle continues in the same direction with similar energy, the move is genuine and participation is real. If the next candle is small, hesitant, or begins to fade, you are watching momentum stall right after its loudest statement. And that combination, large candle followed by sudden quiet, is one of the most reliable signs that the move has said everything it had to say. Most traders watch where a candle closes. Fewer pay attention to where it opens. That imbalance in attention is a mistake, because the open is not just a starting point. It is the market's first statement of intent before any pressure has been applied. Where a candle opens relative to the previous close tells you something immediate and honest. If the new candle opens exactly where the last one closed, the market transitioned smoothly. Participation continued without interruption, without urgency, without any sudden shift in sentiment. But if the new candle opens significantly higher or lower than the previous close, something happened. A decision was made in the space between those two candles. In the overnight session, in the pre-market, in the hours when most retail traders weren't watching. And that decision, expressed through the gap in the open, is often more informative than anything that happens during the trading day itself. This is the part that gets overlooked. The open is uncontested. The moment a candle begins, no one has had the chance to push back yet. The first price of a new candle reflects the purest available sentiment at that moment. What participants collectively believe price should be before the argument starts. That belief, held at the very beginning, shapes everything that follows within that candle. Think about what a strong opening tells you in practical terms. When a candle opens near the top of the previous candle's range, or beyond it, buyers didn't wait. They didn't hold back to see if price would dip. They entered immediately, aggressively, at whatever price was available. That urgency is meaningful. Urgency in markets reflects conviction, and conviction tends to follow through. A market that opens strong is a market that began the period already dominated by one side before any negotiation took place. Now consider the opposite, a candle that opens weak. Below the previous close, below the midpoint of the previous candle's body, is starting the period already on the defensive. Whatever buyers were present at the close of the last candle, they were not strong enough to hold that level through the night or through the gap. Sellers imposed their will before the session even began, and a market that starts a period already losing ground rarely recovers without a visible and convincing reversal signal. Do you see how the open frames the entire candle that follows? It sets the baseline expectation. Everything the candle does after the open is either confirming that initial statement or contradicting it. And both of those outcomes are tradable if you're paying attention. Here's where the practical application sharpens. When a candle opens strongly and then closes strongly in the same direction, the opening intent was validated. Buyers stated their position at the open, held it through the session, and finished with control intact. That's a candle that deserves respect. But when a candle opens strongly and then closes weakly, or worse, closes in the opposite direction, something broke down between the opening statement and the final verdict. The initial conviction was challenged and defeated. That failure is significant precisely because the opening showed such clear intent. When intent is that clear and still fails, the failure carries extra weight. The open also becomes critical when it gaps away from the previous session entirely. A gap open doesn't just show you where sentiment is, it shows you where sentiment shifted while the market was closed, when the least number of participants could respond. Gaps are the market adjusting to information or emotion that built up in the absence of a traded price. They create imbalance by definition, because not everyone who wanted to buy or sell at the previous close had the opportunity to act before price moved. And that imbalance has consequences. Gaps that hold, where price opens, moves in the direction of the gap and never returns to fill it, are some of the most powerful continuation signals available. They show that the shift in sentiment was real enough to sustain itself even when the full weight of the market returned and had every opportunity to push price back. But gaps that close quickly, where price immediately reverses and fills the gap within the same candle or the next, are equally informative. They show that the overnight move was an overreaction, that the market rejected the gap's implied narrative the moment liquid trading resumed. Before a market makes a significant move, it often goes very quiet. That silence is not inactivity. It is pressure building behind a closed door. A sequence of small, bodied candles clustering near a key level is one of the most misread formations in trading. Most traders look at it and see nothing happening. They lose interest. They move on to a chart with more movement, more noise, more apparent opportunity. And in doing so, they walk away from the exact moment the market is preparing to show its hand. Understanding why that cluster of small candles is significant requires understanding what it actually represents in terms of market participation. When candles are small, it means neither buyers nor sellers are willing to commit with full force. The range is tight because every move in one direction is immediately countered by the other side. That balance sounds neutral. It isn't. Because when two forces are locked in a tight, prolonged standoff near a level that already carries historical significance, the eventual resolution of that standoff tends to be sharp, decisive, and sustained. Think of it as compression. Every small candle that forms without breaking the level is adding pressure to the system. The longer price holds in that tight range without resolving, the more trapped participants accumulate on both sides. Buyers who entered expecting a breakout upward, sellers who positioned for a breakdown. As that standoff extends, the losing side doesn't disappear. They wait, and when price finally moves, their forced exits add fuel to the move in a way that a sudden breakout from a trending candle simply doesn't produce. Do you see why patience near these formations can be more valuable than activity elsewhere? The location of this cluster is everything. A sequence of small candles in the middle of a range, away from any meaningful level, carries almost no predictive weight. But place that same sequence directly beneath a resistance level that price has respected twice before, or directly above a support zone that has held multiple tests, and the meaning changes entirely. The market isn't drifting there randomly. It is testing, probing, determining whether the level will hold again or finally give way. There's a psychological dimension to this that mirrors the chart pattern precisely. Traders watching the tight cluster are themselves in a state of indecision. They see the level. They see the compression. They don't want to enter too early and get caught in the chop, but they don't want to miss the move either. That collective hesitation is part of what keeps the candles small, because participation is reduced while everyone waits for confirmation. And reduced participation near a key level means that when confirmation finally comes, the wave of entries that follow is disproportionately large relative to the available liquidity. What you should be watching for within the cluster is any subtle shift in where the small candles are closing. If the bodies, though small, are consistently closing near their highs, even marginally, buyers are winning each individual battle, even if the war looks undecided. That directional bias within the compression is a quiet signal of which side is likely to win the resolution. Conversely, if small candles are consistently closing near their lows despite price sitting at support, the buyers who should be defending that level are struggling to hold it convincingly. The wick behavior within the cluster adds another layer. Small candles with wicks probing below support, but closing back above it, are showing you repeated rejection of the downside. Every probe below the level got bought. That's not weakness. That's absorption. The sellers are testing, and the buyers are passing every test quietly, without fanfare, in candles so small that most observers don't register what's happening. There are moments in the market where the conversation between one session and the next simply stops. No gradual transition, no orderly handoff, just a sudden jump from one price to another, with nothing traded in between. That gap is not a glitch. It is the market telling you that something changed with enough urgency that the normal back and forth process of price discovery couldn't contain it. Most traders treat gaps as anomalies to be managed around. The more useful approach is to treat them as compressed information, a price adjustment that happened too quickly for the market to process in real time, carrying within it the emotional weight of whatever caused the skip. Think about what a gap actually represents at its core. While the market was closed, sentiment shifted. News broke, or didn't break but was felt. Institutional participants reassessed their positions. Orders built up on one side without the release valve of a traded price. And when the market reopened, all of that accumulated pressure expressed itself immediately in the opening price, skipping entirely over the range in between. That skipped range is not empty space. It is unfinished business. This is where the concept of the gap as a statement becomes practical. When price gaps up at the open, it is not simply higher. It is higher without giving anyone the chance to sell into the move at the prices in between. The traders who wanted to exit longs at those intermediate prices couldn't. The traders who wanted to short at those levels couldn't. Those unfilled intentions don't disappear. They wait for price to return. And when it does, that previously skipped range frequently becomes a contested zone, because now the participants who missed their opportunity the first time finally get their chance to act. Do you understand why gaps so often get filled, and why the fill itself becomes a tradable event? But not all gaps fill, and that distinction is where the real intelligence lies, a gap that holds, where price opens, moves further in the direction of the gap, and never returns to cover that space, is one of the most powerful continuation signals the market produces. It means the shift in sentiment that caused the gap was not an overreaction. It was a genuine revaluation. The participants who would normally push price back to fill the gap looked at the new price level and decided it was fair. They absorbed it. They accepted it. And that acceptance, expressed through the refusal to fill, tells you that the move has real weight behind it. The gap that fails tells a different story. When price gaps open and then immediately reverses, closing the gap within the same candle or the next, you are watching the market reject its own overnight conclusion. Whatever caused the sentiment shift that produced the gap was not strong enough to survive contact with the full weight of active market participation. The moment liquid two-sided trading resumed, the argument was settled quickly and decisively against the direction of the gap. That failure is not a minor detail. It is evidence that the gap was driven by thin conditions, emotional reaction, or information that the broader market evaluated and dismissed. There is a specific formation worth watching carefully. When price gaps in the direction of an existing trend and the gap holds, price does not return to fill it even intraday. That gap becomes a line of demarcation. Above it, the trend is intact. Below it, something has changed. Traders who understand this use the lower boundary of an unfilled gap as a reference point, not because of a rule, but because of what it represents: the last place where sentiment was unanimously in one direction before the market ever had a chance to argue. The psychological weight of a gap on participants is also worth considering. A large gap open creates immediate disorientation. Traders who held positions overnight are suddenly in a different reality than the one they fell asleep in. Their risk parameters, their stop levels, their profit targets, all of them were calibrated to a price that no longer exists. That forced recalibration, happening simultaneously across thousands of participants, creates a window of behavior that is often more readable than normal market conditions, because the reactions are less calculated and more instinctive. The candles that move markets the most are rarely the ones anyone saw coming. Not because they appear from nowhere in a purely random sense, but because the conditions that produce them build quietly, invisibly, beneath the surface of what most traders are watching. And when those conditions finally resolve, the resulting candle doesn't just move price. It forces a reckoning. It catches people on the wrong side, in the wrong size, with no clean exit. And their pain becomes the fuel. This is the mechanism behind the strongest candles in any market.